Inflation just posted its biggest monthly drop since 2020. Core prices didn't rise at all, and mortgage rates, they went up. The average 30-year fixed mortgage reached 6.58%, its third weekly increase in a row. If you're waiting for inflation to cool before you buy a home, that sounds completely backwards. It isn't. You're looking at two different clocks, and probably the wrong interest rate. June's inflation report looks backward. Mortgage rates look forward. And if you're waiting for one good CPI report or one Fed cut to bring back cheap mortgages, history has a warning for you. Let's start with what 6.58% actually means. It came from Freddie Mac, and it wasn't a single quote taken on Thursday morning. It was an average of thousands of mortgage applications submitted from July 16th through July 22. It also covers a specific part of the market. Conventional, conforming purchase loans, generally for borrowers with good or excellent credit, and roughly 20% down. So it isn't necessarily your rate. It isn't an APR, which also reflects points and certain fees. And it isn't a promise from every lender in America. It's a national benchmark. Useful, but not personal. Now look at the inflation report. The June Consumer Price Index fell 0.4% from May. That's the largest monthly decline since April 2020. Core prices, excluding food and energy, were flat. That sounds like inflation finally broke. But here's the catch. Prices were still 3.5% higher than a year earlier, and much of the monthly relief came from energy, which fell 5.7%. Gasoline alone dropped 9.7%. So June was much cooler. Inflation wasn't gone. And we've seen this mismatch before. In June 2022, inflation was running at 9.1%, the highest rate in 4 decades. The average 30-year mortgage at the end of that month was 5.70%. By September 2023, inflation had fallen to 3.7%. That was a huge improvement. But 1 month later, the average mortgage rate reached 7.79%, a 23-year high. Put the two periods side by side. Inflation fell 5.4 percentage points. The mortgage rate rose 2.09. Cooler inflation. More expensive mortgage. Now don't turn that into a prediction that today's 6.58% must become 7.79. The dates aren't identical. The Fed was at a different stage of tightening. Mortgage market spreads were different too. History isn't giving us a target, it's exposing the mistake. Watching headline CPI alone failed in 2023. It can fail again now. That doesn't mean inflation is irrelevant. It matters enormously. But a mortgage rate prices more than inflation. It also reflects real economic returns, the expected path of Fed policy, the extra compensation for holding long-term debt, and risks that belong specifically to mortgages. In 2023, inflation improved while enough of those other pressures moved the wrong way. One lever came down. The whole machine still pushed mortgage rates up. Falling inflation can create room for cheaper mortgage, but it isn't sufficient on its own. CPI is the rear-view mirror. The bond market is the windshield. So let's look through the windshield. Mortgage rates usually move with long-term bond yields, especially the 10-year Treasury. They don't match perfectly, but the 10-year is a much better starting point than the Fed's overnight rate. I matched Freddie Mac's latest 2 mortgage survey windows with the Treasury's daily 10-year yields. In the previous window, the average mortgage was 6.55%. The average 10-year Treasury yield was 4.57. In the latest window, the mortgage rose to 6.58. The Treasury average rose to just over 4.60. Mortgage rates increased 3 basis points. The matched Treasury average increased 3.4, near 1-for-1, and the rough spread between them didn't widen. It narrowed by about 0.4 of a basis point. Put that in plain English. The rough match spread doesn't show lenders adding a large new markup. This week's mortgage move mostly followed the long-term bond market. That's the number that unlocks the current story. The historical comparison tells us CPI can fall while mortgages rise. The matched window comparison tells us why they rose this time. Long-term borrowing costs moved up. To be fair, the market did react to the cooler CPI. On release day, the 10-year Treasury yield fell from 4.62% to 4.58%, then other risks took over. Markets don't freeze after one report. Every new piece of information changes the price again. So what pushed the longer-term rate back up? The easy answer would be inflation expectations. But that's incomplete. Across the same two mortgage windows, the average nominal 10-year yield rose 3.4 basis points. The Treasury's real 10-year yield, derived from inflation-protected securities, rose about 2.6. The rough inflation-related difference increased only about 0.8 basis point. Most of the matched increase showed up on the real rate side, not in a sudden explosion of long-term inflation fear. That can reflect stronger expected growth, uncertainty about future Fed policy, or investors demanding more compensation to hold long-term debt. Different cause, same result: more expensive long-term money. The Federal Reserve's June meeting minutes made a similar point. Officials said a recent rise in Treasury yields had mainly reflected higher real rates, while policy uncertainty could also affect the extra return investors' demand for holding longer-term bonds. But oil still matters. June CPI benefited from falling energy prices. July didn't follow the same script. Brent crude rose from about $68.50 a barrel on July 2nd to nearly $87 by July 20th. That's almost 27%. Oil didn't cause the entire mortgage increase. And the larger oil jump reported on July 23 happened after Freddie Mac's survey window had closed. But it does explain why investors couldn't take June's energy relief and project it forward forever. Old inflation data looked better. New energy risk looked worse. Now let's deal with the Fed, because this is where rate coverage gets sloppy. The Fed controls a short-term overnight target. In June, that target stayed between 3.5 and 3.75%. Your 30-year mortgage is not that rate. The path is indirect. Fed expectations affect long-term Treasury yields. Treasury yields help anchor mortgage-backed securities. Those securities carry duration risk and an unusual feature: homeowners can refinance or repay early. That's also why the 10-year Treasury is a useful benchmark for a 30-year mortgage. Most mortgages don't remain outstanding for 30 years. Homes get sold, loans get refinanced, but a Treasury investor can't hand a bond back when rates fall. A homeowner can refinance. That option has value to the borrower and a cost to the investor. Then, lenders add servicing costs, risk, operating expenses, and margin. Finally, credit score, down payment, loan type, location, and points shape the actual offer. It's a chain, not a Fed button. Mortgage rates can separate from Treasury yields when mortgage-backed security spreads or lender margins move. That happened at other points in history, but remember this week's evidence. The simple spread didn't expand. Those layers matter structurally. They just weren't the main reason for this 3 basis point move. So what does all of this mean for your budget? Honestly, the weekly move isn't the scary part. On a $400,000 30-year loan, moving from 6.55% to 6.58% adds about $8 a month in principal and interest. $8. That's not an affordability crisis. Now compare 6.58% with a 3% mortgage. At 3%, monthly principal and interest on that loan is about $1,686. At 6.58%, it's about $2,549. That's roughly $863 more every month. Same loan, very different life. And at June's median existing home price of $440,600, a buyer putting 20% down would borrow about $352,000. At 6.58%, principal and interest alone would be roughly $2,246 a month before property tax, insurance, HOA fees, or maintenance. So 3 basis points is noise. Staying above 6% is the affordability problem. That's why I wouldn't organize a home purchase around the next CPI headline. If you're genuinely shopping, watch the 10-year Treasury for the broad direction. Then compare actual lender offers, including APR, points, and fees. One lender may advertise a lower rate because it charges more upfront. Another may show a higher rate with lower closing costs. The smaller headline number isn't automatically the cheaper loan. And don't ask only, can I qualify? Ask what the total monthly cost does to the rest of your life. So, why did mortgage rates rise after inflation fell? Because CPI described what happened in June. The mortgage market priced what investors saw coming next. History shows that those two directions can separate for months. The current data show that this week's increase mostly followed the 10-year Treasury, with most of the matched move appearing on the real rate side, not in a sudden inflation panic. If you're waiting for one good inflation report to unlock cheap mortgages, you're watching the wrong clock. Watch long-term yields. Compare the offer in front of you and judge the payment, not the headline. This isn't personalized financial advice. It's the framework I'd use to understand what the rate market is actually saying.